a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about the Magnificent Seven stocks and ETFs that provide a lot of exposure to these stocks. So these Magnificent Seven stocks posted an average total return of almost 105% last year, and that contributed about 62.2% of the S&P 500 index's total return last year. So most experts were predicting a broadening of the rally in 2024, but we have seen that the market leadership has narrowed further. Now these Magnificent Seven stocks are driving about 80% of the increase in the broad index. So because of that, the S&P 500 is up about 4% this year, and these seven stocks account for almost 29% of the S&P 500 index. So the equal weighted index ETF RSP is actually down now 1% for the year because we have seen only these stocks running and not much happening elsewhere. And the QQQ index ETF is up about 7% because of its oversized exposure to these Magnificent Seven stocks. So now, last year, all these stocks did quite well, though there was some divergence in performance, but they all benefited from AI hype last year. But now we have seen a significant divergence in performance this year, and that divergence has actually widened. The gap has widened when 5 of these Magnificent Seven stocks reported earnings results. After last year's report, NVIDIA is now up almost 45% of the year, and the company has not even reported yet. NVIDIA will be reporting later this month on February 21st. Tesla, which had reported in the previous week, a couple weeks before, that is down about 27% on growth concerns, and others lie in between. So last year, as I mentioned, they all benefited from AI bonanza, but now investors are trying to figure out which stocks will be the biggest beneficiaries of this AI revolution. And all these mega cap stocks, companies that reported in the past couple of weeks, they all announced very aggressive AI spending plans. And NVIDIA is, of course, the biggest beneficiary of those AI spending plans because of its cutting edge, its market dominance in those cutting edge GPUs. So that is why the stock continues to rise, even though it has not even reported its earnings. Now let's quickly take a look at the performance of these stocks year to date. So as I mentioned, NVIDIA up about 45%. Meta Platform is the second best performer, up about 33%. Amazon about 15%. And then Microsoft about 10%. Google's performance is almost similar to the S&P 500 index. Apple has actually slightly underperformed. It is up just about 1%. And Tesla down 27% for the year. Now let's quickly look at the earnings results before we go to the ETF. So Meta's earnings were loved the most by investors. Shares surged about 20% after earnings, and its revenue jumped 25%. Earnings more than tripled year over year. And then the social media giant announced its first ever dividend and also a 50 billion share buyback authorization. Now, that dividend is still small, but many funds have that mandate of holding dividend paying stocks, so it will make its entry in some of those funds. So that is why another reason why stock benefited. Amazon also delivered significant beats on the top and bottom lines, and the stock was up about 8% after earnings because of strong spending during the holiday season, and its cloud computing division, Amazon Web Services, AWS, that reported a sales growth of 13%. Microsoft also reported very strong revenue and earnings beats, and the software giant has already started monetizing its investments in AI, and its Azure Cloud Computing division that reported a sales growth of about 30% year over year. Apple, they say their sales grew last quarter after four consecutive quarters of year-over-year declines, and its total iPhone sales were ahead of estimates, but revenue in China was down about 13%. So that disappointed investors. Uh, but what investors liked was that Apple CEO Tim Cook said that Apple may have some big AI related announcement later this year. And then there was some positive review, positive feedback on its Vision Pro headsets as well. Google was down about 7% after reporting its earnings. Its cloud computing division reported 26% increase in its business, but advertising, which accounts for about 77% of Google's annual revenue, that reported disappointing growth. So that is why the stock was down. Now, as these stocks continue to do well, so obviously there's a lot of interest in ETFs that have focused exposure to concentrated exposure to these stocks. So let's take a look at those ETFs now. So the first one is Max 7 ETF by Roundhill. This provides exposure to just the Magnificent 7 stocks. It holds only 7 stocks, and it provides equal weighted exposure to those stocks. This launched last year, and this actually launched as Big Technology, Big T ETF. And at that time, it did not have exposure to Tesla and Nvidia, but investors obviously wanted that exposure as well last year because all 7 were doing so well, so that they changed the index and the ticker. And it is not even a year old and already close to 100 million in assets. So pretty impressive growth. Let's go to the quote page on Zacks.com. You can read our research report articles. I did a podcast with Roundhill, and we talked about the ETF as well. Using the link, you can go to the web page for this ETF, the Roundhill web page for this ETF. Expense ratio 29 basis points. At quarterly balancing, all these will be brought to equal weights, but obviously because Nvidia has surged and Tesla is down, so you see this big divergence in current weighting in this ETF. The second ETF that I'm highlighting is an ultra cheap ETF by Vanguard, which has about 60% exposure to these top 7 stocks. Overall, it holds 82 mega cap growth stocks and follows a market cap weighting scheme. Just 7 basis points expense ratio and quite popular with almost 18 billion in assets. Again, let's go to the quote page on Zacks.com, and using the link, you can go to Vanguard webpage for this ETF, and you will see the top holdings as you would have expected. Now, Vanguard, unlike most other ETFs, Vanguard doesn't disclose its holdings on a daily basis. So that's why you see holdings as of 31st December. It discloses its holdings on a monthly basis with a delay of 15 days. The third ETF, which I like a lot and I currently hold in the ETF investor portfolio that I manage, is QQQM. It is the cheaper version of the ultra popular QQQ ETF. So if you are a trader, you will use QQQ. If you are an investor for the longer term, then QQQM. And it has already gathered close to 22 billion in assets, charges 15 basis points. And let's go to the web page, and from there, Invesco web page for this ETF, and not much to see, but you will see those holdings that we talked about. So Microsoft, Apple, Amazon, Meta Platforms, Nvidia, and then Tesla has slipped. Its Broadcom has higher weight than Tesla, and obviously Google has those two share classes, so Google comes up. So currently, because of Tesla's underperformance this year, Tesla's market cap has gone down even below Eli Lilly and Berkshire Hathaway. And on the next slide, I have the comparative performance of these three ETFs versus the S&P 500 index. Now, this is from April 2023, when this Max ETF made its debut. So over this period, the Max ETF is up about 50%. The other two ETFs are up about 37%. And the S&P 500 index is up about 22%. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. And I'll see you next week.